The key word on the chart is secular. The implicit rule we're following is that blue shows secular trends that lead to new all-time real highs. Periods in between are secular bear markets, regardless of their cyclical rallies. For example, the rally from 1932 to 1937, despite its strength, remains a cycle in a secular bear market. At its peak in 1937, the index was 29% below the real inflation-adjusted all-time high of 1929. For a scholarly study of secular bear markets, which highlights the same key turning points, see Russell Napier's Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. An alternate view of secular trends is offered by Ed Easterling of Crestmont Research. See his fascinating study Understanding Secular Stock Market Cycles, which made a persuasive case that we remain in a bear market that began in 2000. The underlying principle, in Easterling's view, is the price-to-earnings ratio, which remains lofty. Ed maintains that even with the lofty market highs, the current cycle has been the best cyclical bull inside of a secular bear. Since that first trough in 1877 to the March 2009 low, secular bull gains totaled plus 2,075% for an average of plus 415%. Secular bear losses totaled minus 329% for an average of minus 65%. Secular bull years total 80 versus 52 for the bears, a 60-to-40 ratio. This last bullet probably comes as a surprise to many people. The finance industry and media have conditioned us to view every dip as a buying opportunity. If we realize that bear markets have accounted for about 40% of the highlighted time frame, we can better understand the two massive sell-offs of the 21st century. For a more optimistic view, see Chris Puplav's assertion in The Secular Bear Market in Stocks is Over. Chris's commentary includes some interesting demographic analysis based on the ratio of the higher earning, bigger spending age 35 to 49 cohort to less financially empowered age 20 to 34 cohort. Unfortunately, this ratio is being savagely trumped by a far more powerful demographic shift, the ratio of the elderly, 65 and over, to the peak earning cohort, age 45 to 54. The elderly cohort is dramatically increasing in numbers. The ratio of the two peaked in 2007 and began its long rollover in 2008, coincident with the beginning of the last recession. We have many years to go before this ratio approximately levels out around 2030. Even more disturbing is the elderly dependency ratio, the label given by demographers to the ratio of the 65 and older population to the productive workforce, which for developed economies is usually identified as ages 20 to 64. The elderly dependency ratio is in the early stages of a relentless rise that doesn't hit an interim peak until around 2037.